Good morning and welcome to today's webcast, How Dealerships Can Stay Ahead During COVID-19. We will be saving time at the end of the webcast to answer your questions. Ask our presenter the question, please type it in the Q&A window and click Submit. If we don't have time to answer your question, we will do our best to follow up with you after the webcast. Finally, in addition to today's presentation, Moss Adams has many resources to help you navigate COVID-19. You can find links to these resources in the slide deck and handouts widget to the left of the slide view. I'm pleased to introduce today's presenters from Moss Adams, Dan Cheyney, National Practice Leader for our Automotive and Dealer Services Practice, Travis Fryant, Tax Senior Manager, and Ken Irwin, Tax Senior Manager. And with that, I will turn it over to Dan to get us started.
Thanks, Emily, and welcome everybody. This is Dan Cheyney with Moss Adams in the Seattle, Washington area. We know every one of you is dealing with some of the most challenging times in your business. We are working hard to get information out as quickly as possible. This is the 6th webinar that the Moss Adams Automotive and Dealer Services Group has participated since the release of the CARES Act on March 27th. Just last night, the IRS released new frequently asked questions document related to the PPP loan provisions, and Emily will post a link shortly, or may have already, to those documents. So this is a constantly developing area, and we just want to make sure everybody is informed as best as they can be. Today our focus will be on the tax-related aspects of the new laws. We will see some overlap with prior presentations regarding the loan program, but our goal is to ensure you know about the tax opportunities that may result in immediate cash to your business. I'd like to first set the stage with a little context. There are 3 new federal laws designed to respond to the coronavirus. The first one, commonly known as COVID-1, was passed on March 6th and had to do with the funding, treatment, and prevention measures. The second one, known as COVID-2, was passed on March 18th and created new rules for employers related to employee leave as well as tax credits for paid leave. It was the Families First Coronavirus Response Act, FFCRA, and we're going to cover some of that today. The third and most significant was COVID-3, the CARES Act, which included over $2 trillion economic relief effort, including significant tax benefits and the new Paycheck Protection Program, PPP loan program. Our focus today will be on the tax aspects of these new laws. Also keep in mind there is discussion currently in Congress about another COVID Response Act, which will be COVID-4, and likely will occur in coming weeks, and we'll be monitoring that and updating you as we learn more information about it. So our agenda for today is to talk about the 2020 deferred tax deadlines, the COVID-19 legislation, specifically COVID-2 and COVID-3, the impacts for business, and the impacts for individuals. We'll also cover some key takeaways and recent updated information. Joining me today to speak about these programs are a few of my good friends at Moss Adams. Ken Irwin sits in our Northern California region and is responsible for many dealership relationships in that region, including the Bay Area and other areas of the country. Travis Fryant sits in San Diego office and is deep in dealership relationships in Southern California, as well as numerous large groups across the nation. Ken and Travis will walk us through the significant tax provisions, then we'll conclude with recent developments and some parting thoughts before we take questions. Ken, take it away.
Thanks, Dan. Hi, everybody. This is Ken Irwin from the Sacramento office of Moss Adams. And let's see, get my slides up here. Before we get into the tax changes and deferrals from the CARES Act, I want to address the deferral of tax filing and payment. So I would imagine most of you guys are aware of this at this point, but what's happening is that anything that was due to be filed or paid by April 15th has been pushed out to July 15th. So what this means is that, so originally what happened was right after our March 15th deadline with the flow-through entities, partnerships and S-Corps, they came out with the deferral of the April deadlines. First, it was just the payment of tax liability, so anything that was due to be paid by April 15th was deferred out to July 15th, and then about a week later, they came out with the actual deferral of filing the tax returns as well. So it gave businesses that had other things to worry about more time to get their information into their CPAs to get the tax returns taken care of. So what got deferred was, again, the filing of the April 15th tax returns. So those are probably mostly your individual and corporate tax returns, and the payment. If you had any liability due with those returns, that is now deferred till July 15th, as well as your first quarter 2020 estimate payments. What has not got deferred yet, anyway, is that the second quarter 2020 estimates that are typically due June 15th are still due on June 15th at this point. So be aware of that in the next couple of months. Let's see. Moving on with the slides. Just a second. State deadline. So, okay, this is another thing that's come out. So a lot of the states have conformed to the federal July 15th deadline, including California. So a lot of you that are sitting in California have your state deadlines pushed to July 15th as well. But what you'll want to check with your CPA is if you're filing in any other states, check to make sure that those states have also moved the deadlines, because you may have an estimate or a liability or an extension due April 15th still. So that's only a week away, so you might want to check on that as quick as possible. And at the end of our presentation, we will have some links to the Moss Adams website where you can go on there too, and there's some handy checklists of the states that and where they're at this point, whether they've conformed or not. Okay, so that is the deferrals. So we'll get into now the changes in legislation from the CARES Act that for the income tax provisions. And where I want to start with is that most of these are changes to the 2017 tax reform. So I'll kind of mention the rule that changed when we filed tax returns last year. We enacted all the 2017 legislation, made some significant changes to your returns. And what this CARES Act is doing really is taking some of the, for lack of better terms, the negative impacts of tax reform from 2017 and freeing those up or deferring them out to where you can use them for your 2019 and 20 tax returns, and also maybe even your 18 tax returns for amended. So I'll kind of describe both, what changed last year and then what happened in the CARES Act. So the first thing that we will talk about is the net operating losses. Let me get over to that slide. So NOL modifications. So first off, in the 2017 Act, which started with your 2018 returns that we filed last year, they disallowed the carryback of any NOL. So for corporations, what this meant was that they made you basically forego the carryback period for any NOLs, and you had to carry NOLs forward. And also with that, if you carried an NOL forward to the next year, you can only use the NOLs to the extent that they would cover 80% of that year's tax liability. So they made it to where there would always be some sort of tax amount due. You couldn't use your NOLs to cover the entire amount of income for the following year. So the changes that happened in the CARES Act was that they basically deferred that out to 2021 and went back to allowing corporations to carry their NOLs back for up to 5 years. And this starts with your 2018 tax returns. So if you're a corporate filing entity, you'll want to check with your CPA and make sure that if you had any losses in 2018, that you might want to take a look at amending those returns, because you can now carry that back for 5 years. And even your current year, 2019 and 2020 returns, if you're in a loss position, you can carry those back for 5 years. And that 80% income limitation rule has also been deferred out to 2021 now. So you could use the NOLs fully and carry them back. One of the nice things with this is that it allows you to carry back your NOLs into a year where the corporate tax rates were much higher. So if you recall, before 2018, the tax rates for corporations were at 34%. And then in 2018, it went to 21%. So now if you had a loss in 2018 or the current year, you can carry those losses back into years with higher tax rates and allow you to get a bigger refund, if you will, on that same amount of income. So you'll want to check into this, check with your CPA, make sure you know where you stand for 2018 as far as corporate NOLs go and how you're using them. Some considerations regarding this: the changes are intended to allow companies to utilize current losses, amend prior year returns, and apply for tax refunds with the goal of increasing cash flow. So it's important to note that really the theme behind the CARES Act is really to allow more cash flow, get more cash into businesses' hands so that they can keep running as much as possible. So that was really for corporate taxpayers. How this affects the individual and flow-through taxpayers is this way. So most of you know that if your entity is a flow-through entity, so it's a partnership or or an S corporation, all the income from those activities flow out to your individual return, and it gets picked up there. So if you had losses, income or losses flowing out to your individual tax return, you would either pay the taxes or take the losses on that return. And what happened in 2018 with the 2017 tax reform was that they started limiting these losses at the individual level. So, for example, if you were a business owner with a flow-through entity and that entity had $1 million loss in 2018, that loss would flow out to your tax return. And before 2018, you were able to take that entire loss, do carrybacks if you could, and that sort of thing. 2018, what happened is that they limited those losses to $500,000 in the case if it's a joint tax return, $250,000 if you're filing single. And so any of the excess would then have to go forward to the next year, in which that 80% rule applied at the individual level too, where you can only offset 80% of your next year income. So this actually had a pretty dramatic effect to companies with some big losses in 2018 and potentially 2019. Now, what the CARES Act did was basically, again, deferred that out to 2021. So you will want to, again, talk to your CPA, see where you stood for 2018 if you had losses from your company or companies. At the individual level, those would be all aggregated together, so you would have to take a look and see where you stood at the end of the day as it pertains to the losses, and look at that, because if you had losses greater than $500,000 filing joint, you would be able to amend those returns, free up those losses, and potentially get some more refunds. So again, talk to your CPA. This is a big issue that could put some more money in your hands. Considerations regarding this, it may require an amended return or accounting method change. Again, check with your CPA to see if that would be necessary. Shouldn't be accounting method change, but it could require an amended return. Probably would if it's 2018. So that kind of covers the losses that were discussed in the CARES Act. The next thing we want to talk about is the changes to qualified improvement property. What this is qualified improvement property has to do with leasehold improvements. So typically if you build a building, it's depreciated, the building itself and all its components are depreciated over a 39-year life. In the past, before 2018, they had what was called qualified improvement property, which was typically any property or any remodels or any improvements that were done to the inside of a building. And typically those improvements were allowed to be depreciated over a 15-year life, and also would be subject to bonus depreciation if you wanted. So you can actually not only depreciate them over a shorter life, but you can expense them too if you needed or could. And what happened in 2018, and this was actually by accident, I won't get into how that happened, but all of the qualified improvement property was changed in 2018 to be treated the way the rest of the buildings are treated, in that they would be a 39-year life. So what the CARES Act is doing now is changing that definition back to where these qualified improvement properties are now back to being a 15-year life and subject to bonus depreciation if you'd like. And remember, the bonus depreciation does allow, you can take bonus depreciation and send your company into a loss if you want, with the bonus depreciation. So for what the CARES Act is trying to do now with their NOLs, if you recall, is, now you're allowed to create NOLs, create bigger NOLs, and potentially carry them back. So what you'll want to do, again, look at your 2018 and 19 tax returns. If the 19s are filed already, if you've had any significant building improvements, remodels, anything like that, you'll want to take a look at how they were treated for depreciation in 2018, 2019, because you can now change those back to 15-year property and potentially expense them, create bigger NOLs, or just lower your taxable income and get the refunds back from these. So I would imagine that there's quite a few of you out there that have done improvements over the last few years, or last 2 years, that this could be an impact for. So definitely check with your CPA on that. Considerations regarding this, if it's 2018, you would have to amend the return. There's a potential that you would have to do an accounting method change, but that would typically only be if you have already filed your 2019 tax return versus extending it back in March. So again, check your tax returns, check with your CPA, see where you stand in this area to see if there's ways to create more expenses back into 2018-19 and get some refunds. Okay, the next area in the CARES Act that has had some change again, relates to a new thing that they did in the 2017 Reform Act surrounding business interest expenses. So again, going back to 2018, when we implemented the 163J business interest limitation, what happened there was that in the past, businesses were allowed to deduct in full the entire amount of interest expense related to their business. So if your business had any debt, any loans to run the business, to keep it going, to get it started, whatever the case may be, the interest on those loans was fully deductible. And then what they did in 2018 was they put this interest limitation in place. And how that worked at a high level was that you would basically take your net income for the year, you would add back depreciation and interest to get kind of a quasi EBITDA number. And that amount times the 30% was the limit to which you could take your interest expense deduction. So that did impact quite a few people that had, especially if they had significant debt on the books. The change now in the CARES Act is that for this one does not go back to 2018. So for years beginning in 19 and 20, they're changing the 30% limitation to 50%. So this should allow higher interest expense deductions for 2019. So, and what is important to know here is that for 2019, this does not apply to partnerships. The rule says here that partnerships are only for 2020. So if you're an S Corp filing entity, you can take this increased limitation in 2019. So you may have had, I know there's quite a few S Corps out there, and you may have filed on time. So if you filed in March 15th of 2020, your 2019 tax return, you'll want to take a look at this because it was probably using the 30% limitation. So you may want to quickly amend that, change that return, and free up a little bit more of your refunds, or pay in less tax than you would have. This is an interesting, this applies to all businesses. It's actually very much more intricate when it comes to dealerships. And I don't want to get too far into the details on how this works because it's a little bit complicated, but this interest limitation for dealerships did not apply to flooring interest. And there was a lot of discussion around that all last year as to how that was going to interplay together. And the high level is that dealerships basically have the option of using or being subject to this limitation on their flooring and being allowed to use bonus depreciation, or using flooring interest fully without this limitation and opting out of being able to use bonus depreciation. So there's some interplay there that gets kind of intricate that you'll have to talk to your CPA about, have them run the different scenarios to see where you stand. This option is a year-to-year basis. So, what happens one year may not be the way you want to do it the next year. It's going to depend on the amount of bonus depreciation that you could potentially have in a year versus the amount of flooring interest that you have, and what's going to put you in a better position. So it's kind of this one's very intertwined with other things for dealerships. So something that you'll definitely want your CPA to take a look at while they're filing your 2019 tax return. Okay. Next subject, we talked about the partnership impacts that what I just talked about is only for S Corps for 2019 and partnerships starting 2020. and this all reverts back again in 2021. Next provision in the CARES Act has to do with a corporate AMT credit, and this is simply with the Tax Reform Act in 2017, the AMT was repealed, and that what they said at that time was that if you had an AMT credit at the time, you can take that credit spread over 4 years. And what the CARES Act has done was allow you to take any of that remaining AMT credit and use it all in the 2019 tax year. So check your return there if you're a corporate taxpayer and you have this AMT credit that you started taking back in 2018 and would be taking over the next 4 years. You could take it all in 2019. So those are pretty much the income tax provisions of the CARES Act. So the next thing that we want to discuss are the payroll and excise tax provisions that have come about with the two different acts. The first one is really a deferral of payroll taxes. What this one does is allows taxpayers to defer the Social Security amount, the employer part of the Social Security tax, 6.2%, that would be originally due starting from March 27th, 2020 to the end of the year, can be deferred and paid 50% on 12/31/21 and 50% on 12/31/22. So you'll need to work with, if you do payroll in-house, this is taken on your payroll tax returns. You would simply just not pay in that amount. You can take that cash, use it for other needs, and then it would be deferred out and paid in 21 and 22. It's important to note with this one and the next one that Travis will be talking about, that this can only be taken if you are not taking the SBA PPP loan. So if you are, if you have applied for that loan and you're going to get that loan, just note that you cannot take this deferral. It's one or the other. Okay, with that said, I'm going to hand off to Travis, who's going to continue talking about the payroll credits and deferrals and a few other things. Travis?
It looks like Travis's call just dropped, so he should be joining us again in just a quick second here. Thanks, everyone,
Maybe
for
while
your
we
patience.
give Travis a moment, I'm just going to add a comment, Ken, to what you said. The interesting thing about these two credits that we're going to talk about is that they put different provisions in each one of them. And so for the deferral of the payroll taxes, you can actually borrow on the loan. You just can't have the loan forgiven, which I think most people know that the primary reason why they would borrow on the loan is to have the loan forgiven. Where this one, just borrowing on the loan, the one that Travis is about to talk about, results in not being able to take this credit. And so it's interesting that they put these kinds of distinctions in there, and they kind of make it probably a little bit more complicated than it needs to be, but just a clarification there. Go ahead, Travis.
Great. Thanks, Dan.
All right, thank you. Okay, so onward, looking at some of our the next kind of subject topic that we're hit on are some of the payroll issues and the new payroll tax credits. that have been enacted with this various COVID legislation. And so a big piece of the legislative intent and a lot of the funding associated with that that's come out of these acts that have been approved through Congress is putting money back in the hands, or keeping money in the hands of employees. And really the mechanism that's going to be used for that are the payroll tax credits, and using those in conjunction with employers to both incentivize and reimburse them for the costs of keeping the paychecks flowing. So really when I look at these new credits that have rolled out, I see them in two buckets in my mind. The first bucket are the credits for your employees that are unable to work, meaning they're out either sick or they're out caring for a family member or a child. The other bucket are the credits for incentivizing employers to keep employees on the payroll despite some sort of economic hardship that we're experiencing because of this. So that's going to be the first one that we're going to talk about, is this incentive type credit called the Employee Retention Credit. And what this credit is being offered a 50% credit, basically 50% of the wages paid to employees if you're considered a qualifying employer, which we'll get to, in each quarter up to a total of $10,000 per employee for all of your quarters. So this is going to be a maximum credit of $5,000 per employee that's going to be going back to the employer. And the way that this is going to work is that it's going to be an offset to your FICA taxes that are due when you file your payroll tax returns. And to the degree that there's any excess credit over and above the FICA taxes and your other employment taxes that are generally required to be withheld and then remitted to the government, that piece is going to be refundable. And again, this particular credit, it's worth mentioning. Again, this is an incentive type credit, so employers are not required to take part in this, but if you do, they're putting the carrot on the stick out there to at least somewhat halfway fund the keeping employees on payroll. All right, so to qualify, excuse me. So to qualify to be a qualifying employer for purposes of claiming this credit, you really have to be experiencing one of these two scenarios down here. The first circumstance you can have is that either you have a partial or a full suspension of your operations due to some sort of governmental order. So I think that almost every dealership in the country will probably fall under this category based on what's going on. And as far as the state and the local shutdowns that are in place, it's hard to imagine a dealership that hasn't at least seen a partial suspension of their operations due to one of these governmental orders. So most dealerships are going to be falling in this first category here as far as qualifying to take this employee retention credit. If for some reason, or if there's a different business out there that has not been limited by one of these suspension of operations pieces, then the other way that you can qualify to be able to take this credit as an employer is if you have a significant decline in gross receipts. And what they've come out with as far as the definition of what a significant decline in gross receipts is that basically you're looking at this on a quarter-by-quarter basis. You look at your 2020 quarter, and you compare that to your 2019 same period quarter, and if your gross receipts have dropped by 50%, then that puts you in the qualifying zone. And then you stay as a qualified employer based on that drop in gross receipts until the quarter that your gross receipts have recovered to the point that they're 80% of what they were in that same period in 2019. And this provision is set to go through the end of 2020. It's also probably worth mentioning that this applies to wages that are paid after, it begins on wages that are paid after March 12th. Let's see. Now again, what are eligible wages? It's going to depend on how many employees that you have. So if you have 100 or less employees, then you're allowed to take this credit on all of your wages to any employees, regardless of whether you have them working or if they're staying at home collecting a paycheck. If you have a business with greater than 100 employees, then you're only allowed this credit for wages that are paid to employees who are not at home, who are at home, who are not actively working. So that's one nuance of this I need to keep in mind based on the number of employees that you have. And what is reimbursable as far as into these credit buckets is it's your wages plus the cost of your employer health care costs. Tax-exempt employers are also eligible for this credit. And pretty significantly also, there's a new form out that IRS has put out to handle these claims, this Form 7200. And what this form is used for is if you anticipate that your employment tax withholdings are going to be less than the credit that you're going to be owed when you file your payroll tax return, then you can go ahead and file this form with the IRS. And what it is, it's a request for an advance payment of the credit. This can be filed multiple times, even in a single month. But if you're anticipating that you're going to have a shortfall of cash based on what you have on hand that you normally would have withheld that you are retaining to pay these wages, and what you're going to receive when you file your payroll tax return, you can get an upfront payment of that cash. And again, the IRS is supposed to be fast-tracking the processing of these forms within a couple of weeks of receiving them. Not surprisingly, you're not going to be able to do any sort of double dipping on using the wages for multiple credits. If you're using these wages and applying them towards the employee retention credit, you cannot use those same wages for any other credits, such as work opportunity tax credit. And this is another one of the provisions where you're not going to be able to use this credit if you've taken out one of the PPP loans through the SBA. The other piece, the second bucket of credits, these are the ones that really refer to the payments that are going to be received by employees for when they have personal circumstances that are preventing them from working, be that they are either sick or they're caring for a family member or they have child care issues due to the closure of schools or daycares. And so these payroll tax credits, if you are an employer that is required to pay these out, then you will be eligible for receiving a reimbursement credit. And again, this is similar to the retention credit in as far as the mechanism for getting a refund is going to be through your payroll tax returns and your payroll withholdings. And what it really is there's two pieces of these payroll tax credits related to this. One is the paid sick leave, and then the other one is the paid family leave credit, which is an expansion of the existing Family Medical Leave Act. So this credit is available to employers with 500 or less employees. And one thing that we definitely want to emphasize here is that there are some legal definitions involved in determining whether you have 500 or less full-time employees. So Department of Labor laws are extremely complex. So the recommendation would be to consult with your employment law attorney if there's any question whatsoever. If you're falling on one side or other of this threshold, you're definitely going to want to consult and get a qualified legal opinion as to where you stand on this. So, because credit, if you are considered to be an employer with over 500 employees, you are not required to pay these leave credits, but you're also not entitled to receive reimbursement through the credit process. So we're going to be looking at what's going on with the employers that are subject to paying out these leaves, and who then also by default, if you're required to pay out the leave wages, you're also eligible to receive the credit. And again, this credit is going to be 100% of the wages that you pay, as opposed to the retention credit, which is 50%. And again, this goes against your employment taxes. So the first piece is the paid sick leave credit, and there's basically two subcategories underneath that. The paid sick leave for yourself, meaning the employee, if the employee is going out for they themselves are sick, then the credit's going to be 100% of that employee's normal pay for 2 weeks, maximum of $511 a day per employee. The other piece of the paid sick leave piece is that you can go out to care for a family member that's sick. If that's the case, then you're going to get, the employee is entitled to 2/3 their normal pay for 2 weeks, maximum of $200 per day per employee. Now, the other piece is the expanded paid family leave credit. This one is eligible employees are entitled to 10 weeks at 2/3 of their normal pay. And again, this is going to be a max at $200 a day. So this credit is going to be available for employees that are out because they're taking care of a child who has been basically displaced because their school or their child care facility has been closed. So in total, you're looking at a potential 2 weeks of sick leave paid to an employee plus 10 weeks of additional paid family leave for a total of 12 weeks that's going to need to be paid out at these varying rates. So here we can see a little bit of a recap of the numbers behind that. Okay, and so again, the recommendation would be document as far as your eligibility and tracking of all of these expenses. Historically, anything to do with payroll taxes needs to be on the up and up. So I would expect that once the dust settles on this, if there's any perceived abuses related to payroll taxes in this credit program, that you're not going to want to be on the wrong end of the stick on that one. Okay, a couple of miscellaneous things. Some of our excise tax exemptions. If you are a producer of liquor and you've converted your operations to make hand sanitizer, you are getting the tax break on your excise taxes. There are also some aviation-related ones. So quickly moving through some of our individual pieces. Everyone's likely heard of the recovery rebates that are coming through for individuals. If you qualify based on income levels, it's $1,200 per person, $2,400 for a married couple, and there's additional $500 available for a qualifying child, which is basically the child that you're allowed to claim as a dependent that's under the age of 17. Here are the lower income, the lower thresholds of where the amount of the credit that's being given to individuals starts phasing out. You see a single person, if you go over $75,000, you'll start losing a piece of your credit. It's $150,000 for married, filing joint. Here are the upper limits of the credits. You see that single taxpayer, by the time they hit $99,000 with zero dependents, you're completely phased out of the credit. These credits are going to be based on, if you filed a 2019 return, they'll look at your adjusted gross income to determine your eligibility. If you haven't filed a 2019 return, it'll be based on your 2018 return. If you haven't filed a return, then they will look to Social Security records to determine your income levels. Then come 2020, they're going to rerun this calculation to see what sort of true-up is required. So if your 2020 income level drops down, then you will receive potentially an additional credit if you were quote-unquote overpaid because your credit was based on a calculation of 2018 or 19 income. You're not going to be required to repay that credit, and this credit is not taxable income to any of the recipients. Moving on, charitable contributions. For non-itemizers, there's a $300 above the line deduction available. Charitable contribution limitation, which previously was at 60% of your AGI, has been increased to 100% for 2020, as long as those charitable contributions are cash and they're not made to a donor advised fund. Retirement funds that have changed. So you can now take a $100,000, basically an emergency distribution from your retirement account. The early penalty of 10% is waived, but it's still included in income. You can either spread it out over the next 3 years or include it all in 2020. Depending on what your income level is in 2020, there may be an advantage to taking advantage of certain tax brackets if you expect higher income in 2021 and 2022. I've also raised the loan amount to $100,000, and it's also important to note that if you take a distribution, an early distribution out of your retirement fund, and then pay that back within the 3 years, that it's not considered taxable, though you may have to file an amended return to achieve that. And they've also suspended the RMDs, required minimum distributions, for 2020. Related to student loan provisions, employers can now pay a little over $5,200 for employee educational expenses, and it's going to be tax-free. It also permits those with student loans to make a repayment up to $5,250, which is going to be considered an educational expense. Here's some considerations basically on timing the filing of your income tax returns. If you think you're going to be eligible for a recovery rebate in 18, based on 18 income, but not in 19, you may want to consider delaying the filing of your return. And again, looking at the RMD requirements and the IRA distributions, there may be some benefit there. And we've kind of touched on the excess business losses here, but very quickly reiterating what sort of effect this might have on individual level. Losses that were previously not allowed and were converted into NOLs are now fully deductible to the extent that they were not limited under any other provision. So again, the recommendation is go back and look at 2018 and look what was filed there. There may be an opportunity to amend and create some additional cash flow. And again, the NOL provisions, you can now carry back NOLs. So looking back at 2018, there may be an opportunity to amend and carry back an NOL for an additional cash infusion. And we've also already touched on some of these provisions as far as the business interest limitations and the fix to the qualified improvement property. where some large leasehold improvement deductions may now be eligible for 100% bonus depreciation. And again, really what we want to get across here is that working with your CPA to look back with a big focus on 2018 and 2019 for opportunities with these changes to go back and amend and take advantage of some of these provisions that can provide you with cash through an amended return or filing of an accounting method change. With that, I'll hand it back over to Dan.
Awesome. Thank you, Travis. I was looking up some answers to some of these questions, but we'll move quickly through this and try and get to your questions. Just some thoughts on navigating these provisions. They are surprisingly complex. You do want to work with your advisor on this. There are significant tax benefits currently that affect your 2019 returns. Some of those may result in you not owing as much, so that's not as good of news, and we obviously have the deferral until July 15th to make what would normally be due in April. And some of them are significant enough for some taxpayers where there's an opportunity to get a cash refund now. And so taking advantage of those obviously is super important. The other thing to keep in mind, and this is just kind of looking out into the future a little bit, we're going to, through many of these provisions and these loan programs, we're pushing the bill out until later. And as we get to the end of 2020, hopefully this cash has helped impact your business in a very positive way and helped you navigate this difficult time. But what will also happen is things like our inventory levels will decline and things like LIFO may become an issue. And so preparing as you come out of this, and focus on today obviously for now, but as you come out of this, be aware that in 2021 some of these things will cause a cash cost, and paying those employer payroll taxes, for example, at the end of 2021. So thinking about those issues going into next year. Just a quick comment, most of the dealers in the nation got a notice from the IRS regarding their reinsurance companies. These notices, as far as we can understand, and in consulting with NADA and numerous captive providers, the consensus is not responding to those notices. The response isn't necessary. What we understand is that dealers were not the only ones that received these notices, that there was over 150,000 notices sent out related to these arrangements. So we're working with the NADA to have a meeting with the IRS to discuss how the auto industry responds to this, and we'll have more information in coming weeks, and we will be working directly with you as our clients to navigate it. But it was really just a broad-based letter that went out to kind of everybody that ever owned any one of these types of arrangements. Just another slide for everybody to consider. These are some of the ideas. We're having lots of conversations with lots of clients, and we wanted to put a slide in here with some of the cash management ideas that people have put in place. And so that's there for you to look at maybe after the presentation. And key takeaways, you know, we're preparing for the worst and hoping for the best. The most important thing, I think, is to seek out this information, stay informed, attend webinars like this, consult with not just tax counsel, but legal counsel. A lot of these payroll provisions are more employment law than they are tax law, and that's why we don't go as deep into them. So working on those areas, and Moss Adams, NADA, the American International Auto Dealers Association, your state associations are all working nights and weekends trying to keep you informed and trying to prepare you for taking advantage of as much of this stuff as you can. Just another comment, I think we posted in the link to the frequently asked questions that came out on the IRS. You can also find it on the IRS Coronavirus Tax Relief page. Those frequently asked questions are specific to the new loan program and provide additional guidance as to the definition of a small business, and are, I think, going to be very helpful for people. So please go to that after this presentation. You can also go to the Moss Adams COVID page, and these links will be in the slide deck that I believe you receive after the presentation. So Emily, I think it's a good time to turn it over for questions.
All right, thank you. So we do have a couple of questions. And just a reminder, if you have any further questions, you can still enter them in the Q&A window. And let's go ahead and see. We have employees taking turns working. Can we still apply for the credit for all of their wages, or do we need to split them somehow?
So maybe I'll take this one on. This is Dan Cheyney again. I think what you're referring to is the employer retention credit, and just in specific to that one, if you have under 100 employees, you get that credit for all wages paid to all employees. And that credit you do not get if you borrow money on the PPP loan program, the new loan program. So if you're having people work part-time and trading shifts, you would only get that credit for the people that are working part-time. If you have over 100 employees, you only get that credit effectively for paying somebody not to work. And so if you're paying them for full-time work and they're only working part-time, you'd only get the credit for paying them not to work. That's my understanding. I don't know, Ken or Travis, if you have anything to add there.
Nope, that sounds about right, Dan.
Thank you. We could probably squeeze in one more question. I wanted to verify that the leasehold 15-year depreciation is for interior remodels only.
Yeah. Hi, this is Ken Irwin again. Yes, typically that's the case. So the way you want to think about it is things that are really part of the building are things that are not going to qualify. So structural kind of remodels and that sort of thing that's actual building components are not going to qualify. If it's things that you're doing to the interior of a building that can be removed, moved around, that sort of thing, partitions, stuff like that, then those would be qualified leasehold improvements. Most of the time it's when you're doing a remodel to the interior of your building. So yeah, it's typically the inside. I wouldn't discount anything that's may look like it's part of the building. That's why we go into talk to our cost segregation folks about, because they take real deep dive into what qualifies and what doesn't. But as a rule of thumb, yes, it's usually the interior improvements. But you know, if it was a big remodel that you did, it'd be worth checking in with some of the fixed asset cost seg folks.
Yeah, Ken, I was just going to add that if you've recently had a cost segregation done and you're working with Moss Adams, we are going back through 2018, 2019 additions currently for our clients in identifying those assets to see if there's an opportunity. Our cost segregation teams did a kind of an estimate of that because we anticipated this change in law coming at some point. And so many of the cost segs that have been performed related to 2018 and 2019 remodels, we've got an idea of what that number is, and you'll be hearing from us if you're working with us.
Yeah.
All right. That is just about all we have time for. We did have some questions we didn't get to, and we'll be doing our best to follow up with those of you that asked those after the webcast. If you continue to come up with questions for our presenters, you may ask them questions via the speaker bio widget. All their contact information is there. And thank you, Dan, Travis, and Ken, for a great presentation today. We certainly covered a lot of material. For more resources and the links that Dan referenced here, you can check out our slide deck and handouts widget, which is to the left of the slide view. And we will be sending the slide deck via email after the webcast. Here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Oh, and it looks like our link didn't come through, so I will be sending that in the slide deck email as well. And thank you for joining us, and we hope you'll join us again next time.